Welcome back to the Deep Dive, and get ready to sharpen your focus. Today, we are taking a scalpel to the Q3 2025 earnings season for the specialty property and casualty insurance market. And we're not just reading the headlines. We are zooming in on three very distinct players who, represent fundamentally different strategic approaches right now.
That's exactly right. We have HXIS Capital, the global heavyweight. Then there's James River Group, which has been in the middle of this high-stakes, really dramatic corporate turnaround.
And the powerhouse, Kinsale Capital.
And the high-efficiency ENS powerhouse, Kinsale Capital. What makes this quarter so fascinating is that these three companies are, they're operating in the exact same market.
Right, same headwinds.
Yeah.
Softening property rates, social inflation.
All of it. And yet the reported results reveal three completely separate realities.
So our mission today, armed with the transcripts, the analyst notes, all the key financial figures, is to really cut through that complexity. We want to compare their strategic directions, their headline profitability, and crucially, how they are positioning themselves for a future where, simply relying on rate increases just won't be enough anymore.
Exactly. Think of this as your essential shortcut to understanding where the smart money is moving in this highly technical world.
We're distilling exactly what you need to know about the quarter that ended September 30, 2025.
It's a study in contrast, really. And we'll be using all the defining metrics from combined ratios to prior year reserve development to show the fundamental competitive differences that are emerging right now.
Okay, so let's jump straight into the numbers that matter most. Profitability and efficiency.
The bottom line.
Exactly. For P&C companies, the ultimate measure of operational success is that combined ratio. If you're below 100%, you're making money on underwriting alone. So let's start our comparison with HXIS Capital. What did the big established player deliver?
AXIS delivered a quarter of really powerful, consistent execution. It significantly surpassed what investors were expecting. They posted strong operating income of $255 million.
And that translated to what, per share?
That came out to $3.25 in earnings per share, or EPS. And that wasn't just a beat, it was a significant 13.24% surprise over the analyst forecast.
Wow. And their statutory net income?
Reached $294 million, a very solid number.
And that key efficiency metric, their combined ratio, was exceptionally strong at 89.4%.
It was. That puts them squarely in the high efficiency zone, especially, when you consider their global breadth and their reinsurance exposure. And 89.4% is just indicative of highly efficient underwriting and really tight expense management.
So they're not just chasing that top-line growth at the expense of margin.
Not at all. And this operational success was reflected in their capital metrics, too. Their annualized operating return on equity, or ROE, stood at a very robust 17.8%.
Very healthy.
And their book value per diluted common share was up 14.2% year over year, hitting $73.82. For AXIS, this quarter really just solidified their narrative. Sustained, predictable, and highly profitable momentum. They're hitting their stride after years of strategic refinement.
Okay, so a very strong, very clean quarter from HXIS. Now let's turn to James River Group, JRVR. Their profitability story is... well, it's notoriously complex, isn't it?
It is. They are in the middle of this massive, dramatic strategic transformation. It involves cleaning up years of legacy issues, and you really have to look closely at the numbers to understand the JRVR story.
Because on the surface, it doesn't look great.
On the surface, no. They reported a small net loss from continuing operations of $376,000. That amounts to a negative 1 cent per share. If you stopped reading there, you would think the company is really struggling.
But the adjusted metrics, that's where the real story is. The story of the turnaround management is executing.
They changed the picture dramatically. Their adjusted net operating income, which, strips out all the noise of those legacy accounting adjustments we'll get to later, was $17.4 million.
Okay.
Or $0.32 per share. And this figure absolutely crushed the consensus forecast by 33.33%.
So the underlying current business is performing extremely well.
Extremely well. And that strong operational result drove their annualized adjusted net operating ROE up to a very impressive 19.3%.
But the most staggering number in their entire report, the figure that really validates their transformation, has to be their combined ratio.
I agree completely. JRVR posted a combined ratio of 94%. We have to pause on that number for a second.
Just think where they were a year ago.
Exactly. A 94% combined ratio is a monumental turnaround. It was down over 40 percentage points from that dismal 135.5% they reported just 1 year prior in Q3 2024.
40 points. That is it's a massive swing.
It's the clearest evidence yet that management's deliberate efforts to improve underwriting discipline, reduce volatility, and cut their risk profile are translating into real, tangible profitability. This allowed their tangible common book value per share to grow 23.4% year to date, up to $8.24.
So it's not just an improvement, it's a complete reversal of fortune. It shows their new book of business is generating significant profit.
Precisely. They are successfully creating a firewall between the past and the present.
Okay, so from the turnaround story to the gold standard, let's talk about Kinsale Capital. They are so often held up as the market's efficiency champion in the E&S space. Did they maintain that position in Q3?
Kinsale continues to perform at an elite, almost unbelievable level. They reported a 24% increase in operating earnings per share, reaching $5.21.
Incredible.
Their 9-month operating ROE hit an impressive 25.4%, which is absolutely league-leading, and their book value per share increased by 25.8% just since the start of the year.
So they are just generating capital faster than virtually anyone else.
By a wide margin.
And what was that all-important efficiency metric? The combined ratio.
So Kinsale reported an exceptionally strong combined ratio of 74.9%.
74.9.
Yes. And let's just unpack what a sub 80%, let alone a sub 75% combined ratio means in this industry. It means that for every dollar of premium they collect, they are spending less than 75 cents on claims and operational expenses.
And that 25-cent difference is pure underwriting profit before any investment income.
Pure underwriting profit. This level of efficiency year after year, it just reflects tremendous structural discipline, a unique low-cost technology platform, and really surgical underwriting selection.
We did note a small technical point for Kinsale, though, a missing data point.
We did, yes. Kinsale Capital didn't disclose their GAAP net income this quarter. They chose instead to focus the narrative on their operating earnings.
Which is pretty standard practice for a lot of insurers, but it's worth noting.
It is. But that said, their operating earnings metric and that 74.9% combined ratio, well, they give us a very clear, unambiguous proxy for their overwhelming underlying success.
Okay, so let's synthesize this first theme. We have 3 really distinct narratives here.
Very distinct.
Kinsale is the absolute efficiency leader, leveraging technology to generate a sub 75% combined ratio. Then you have AXIS, demonstrating rock-solid, consistent performance, comfortably beating expectations with a combined ratio in the high 80s, driven by scale and modernization.
And then there's JRVR, the high volatility, high reward turnaround story, validating its whole strategy with a dramatic 40-point swing to achieve a profitable 94% combined ratio. The contrast is just crystal clear.
It really is. Kinsale proves that structural efficiency is king.
AXIS proves that global scale and discipline modernization pay off.
And JRVR shows that decisive and, frankly, painful action can lead to a very rapid financial recovery.
That's a perfect summary.
Okay, so profitability tells us what happened in the past quarter, but growth. Growth tells us where companies see opportunity, where they're choosing to lean into the market cycle.
Exactly.
Let's shift our focus to production gross premiums written, or GWP, starting once again with AXIS Capital.
AXIS showed very robust growth, which is a real sign of confidence in their current pricing environment. Overall, GWP increased by 9.7% to $2.1 billion. That is significant expansion.
And if you break that down,
Breaking that down, their insurance GWP was up 11%, which actually marked a record third quarter for that core segment, while their reinsurance GWP grew a very solid 6%.
and that's the key point, isn't it? A 9.7% increase in GWP while maintaining an 89% combined ratio suggests they're not just growing, but they're capturing share in highly profitable areas.
It's the holy grail, and management was very clear on this. This was strategic growth. New and expanded initiatives contributed nearly 70% of that insurance growth.
So it's not just rate increases on existing business, they're actively expanding.
Exactly. It tells us they're successfully diversifying and entering new niches rather than just relying on existing accounts rolling over. Geographically, they saw specific strength in North America, particularly within the wholesale lower middle market segment.
That's a sweet spot right now, isn't it? Smaller accounts with less intense competition.
It is, and globally, they maintained lead product positions in the London market across complex lines like marine, energy, and construction. They are using their entire global platform to seek out specific pockets of premium adequacy.
Okay, now let's look at James River Group. Their whole strategy involved massive de-risking, which often means Well, an intentional reduction in written premium.
And that's exactly what their Q3 numbers reflected. JRVR's overall GWP declined 8.9% in their excess and surplus, or E&S segment.
But this wasn't a market failure. This was by design.
Completely by design. Management emphasized this was a direct reflection of intentional underwriting decisions. They are deliberately walking away from business they deem volatile, unprofitable, or underpriced. They're prioritizing smaller, historically more profitable accounts over sheer volume.
So an 8.9% decline sounds bad on the headline, but it was offset by retaining more of the business they did like.
That's right. They strategically increased the amount of business they retained, meaning that net earned premium actually grew 1% in the E&S segment. But the real story is the segmentation within that E&S book.
Okay. Their specialty division showed significant strength. Allied Health was up over 20% for the second quarter in a row. Energy was up 16%. Life Sciences grew 10%.
But that growth was deliberately offset by huge cuts elsewhere.
Huge cuts, significant strategic declines in lines they're either exiting or severely cutting exposure to. Excess property dropped 38.2%. Manufacturers and contractors fell 30%. They are actively sculpting their portfolio towards stability and away from volatility.
That 38% drop in excess property is a massive statement about their current risk appetite, especially in a market segment that's getting more and more crowded.
It is. It's a decisive retreat from a segment they clearly feel is underpriced and overcapacitized. It just validates their whole strategy of shrinking to become healthier.
And finally, what about Kinsale Capital's premium growth?
So Kinsale saw overall GWP growth of 8.4%. And like James River, their growth was definitely affected by that softening property market. Their commercial property premium dropped 8%.
Which is a big number, but I think it was even higher last quarter. You're right. Management noted that the pace of this decline was actually slowing down. It was a 17% drop in Q2, so an 8% drop in Q3 shows some moderation, some stabilization in that decline.
So if we strip out that weak property segment, the core of their book must have been extremely strong to deliver 8.4% overall growth.
Incredibly strong. The overall growth rate, if you exclude the commercial property division, was 12.3%.
Wow.
That is a huge internal growth engine. Management noted that all property lines, except for that large commercial property division, grew at a double-digit clip. Kinsale is just focused on maximizing market share in every single niche where their low-cost advantage gives them a profitable edge.
And they highlighted some specific areas.
They did. Their strategic focus highlighted strong growth in newer segments like transportation and agribusiness, and they're also pushing into high-value homeowners and personal lines.
So the key takeaway from the growth theme seems to be that this is no longer a rising tide lifts all boats market.
Not at all. Growth for all three of these companies is surgical, it's selective, and it's highly deliberate. They're prioritizing specific pockets of specialty risk over just broad market share.
All right, now we move beyond the headline figures and look into the real nuts and bolts of underwriting quality. This means analyzing the specific components that drive the combined ratio loss and expense and the impact of catastrophes and the critical issue of prior year development, or PYD.
This is the section that truly reveals which companies are disciplined and which are just, getting lucky.
Exactly. Let's start by looking at the underlying performance, which we measure through the accident year loss ratio, excluding cat losses, and the expense ratio. For AGSS, what did their operational ratios look like?
So XIS reported an accident year loss ratio ex-cat of 56.3%, pretty solid. On the expense side, their general and administrative, or G&A ratio, was 11.7%.
And they have a program for that, right?
They do. Management highlighted that this G&A ratio reflects the ongoing systematic execution of their How We Work program. It's a strategic initiative targeting an 11% EA ratio in 2026.
So this isn't a one-off cut. They're making structural changes.
Yes, they're modernizing their infrastructure, particularly through technology, to achieve permanent structural expense reduction.
Okay, and JRVR is focused intensely on cost containment as part of its turnaround. Did that show up in their ratios?
It certainly did. JRVR's E&S accident year loss ratio was 63.5%, which was 1.2 points lower than the prior year quarter. A nice improvement they attributed largely to their improved business mix.
And the expense side.
That was even more significant. Their group expense ratio fell significantly to 28.3%. That's down over 3 points year over year. And this success is directly tied to their turnaround strategy, which involved reducing headcount and streamlining professional fees. They are successfully trimming the organizational fat.
And what about Kinsale, the benchmark low-cost provider? Did their expense ratio reflect that advantage?
This is where we see a really interesting technical quirk. Kinsale's expense ratio, actually, it increased slightly. It reached 21% from 19.6% last year.
Huh. That's surprising. The immediate reaction might be concern.
It might, but management was quick to explain that this rise was directly attributable to lower ceding commissions.
Okay, let's clarify ceding commissions for everyone listening.
Sure. So when an insurance company like Kinsale buys reinsurance, they cede or hand over a portion of the risk and the premium to the reinsurer. In return, the reinsurer usually pays the primary insurer a ceding commission.
Which is basically income to reimburse them for the cost of finding that business.
Exactly. Well, in Kinsale's case, they decided to keep or retain a larger portion of their highly profitable business when they renewed their reinsurance on June 1st. When you retain more risk, you cede less premium, and as a result, you receive less ceding commission income.
Which technically inflates the expense ratio.
Exactly. So this increase in the expense ratio isn't a failure of cost management at all. It's a strategic choice to maximize retention of their superior underwriting margin.
A perfect example of why diving into the details is so crucial. Okay, next, let's look at the impact of catastrophic events, the CAT impact.
For XSIS, CAT losses amounted to 3 points on the combined ratio, totaling $44 million. And this was broken down into two components, which really highlights the complexity of specialty insurance.
What were they?
So $24 million came from severe convective storms in the U.S., which is, typical seasonal weather volatility. But the remaining $20 million was related to the Middle East conflicts impacting their specialized lines like marine, terrorism, and political risk. It shows how global specialty insurers face exposure that goes far beyond just weather.
And the others?
Kinsale reported minimal C8 losses, less than 1 point. That was a sharp reduction from the 3.8 points they experienced in Q3 of 24. And James River Group. They didn't disclose any specific CIG losses this quarter, which usually suggests they were either minimal or just covered by their existing reinsurance layers.
All right, now we arrive at prior year development, PYD. This is the one that causes analysts the most stress because it's a direct measure of how good your reserving was in the past. Let's start with AXIS.
AXIS reported favorable reserve releases of $19 million, which provided a nice beneficial effect on their combined ratio. This was split between $15 million in insurance and $4 million in reinsurance.
And where do those releases come from?
Management noted they were primarily from short-tail lines, specifically property, credit and surety, accident and health, and agriculture. Short-tail lines are those where claims are typically reported and settled quickly, so it's easier to predict their ultimate liability. It gives management confidence to release reserves once those positive trends emerge.
Okay, pretty straightforward. James River Group's PYD, on the other hand, is the most critical event of their quarter. They completed their annual detailed valuation review, or DVR.
Right, and this DVR is an exhaustive, ground-up review of every single liability reserve. The outcome of this deep dive was a significant $51 million charge related to accident years 2022 and prior.
And this is driven by what, specifically?
Primarily by adverse development in long-tail liability lines, like other liability occurrence and products completed operations.
Management framed this as walling off the past. But fundamentally, the reserves fail to adequately cover those old risks. Isn't that still a sign of an underlying failure that investors should be wary of, regardless of the reinsurance cover?
That is the essential question. It absolutely confirms that the underwriting philosophy in those legacy years, 2022 and prior, was flawed, and that the reserves were deficient. There's no getting around that. However, the crucial strategic point is that this $51 million charge was entirely ceded to legacy retroactive reinsurance covers they had strategically purchased last year.
So the covers worked exactly as intended. They absorbed the shock.
They absorbed the entire shock, preventing it from hitting current earnings. So the purpose of the charge was to clean the slate using the exact tool they bought for that purpose. It validates the decision to buy the cover. And critically, management stressed that they experienced zero adverse development for the period of 2023 through the current accident year. This highlights that clear demarcation they keep talking about, a line drawn between the legacy portfolio and the positive trends of the newer de-risk portfolio, which is generating real profit.
So we can view the $51 million as the final, necessary cost of cleaning up the past, rather than a condemnation of their current underwriting.
That is exactly management's narrative, and the data for the current business really supports the success of their de-risking strategy.
Okay. Finally, how did Kinsale, the conservative reserve setter, fair on PYD.
No surprise here. Kinsale reported 3.7 points of net favorable PYD, which was actually an increase from the 2.8 points they reported last year.
So consistently favorable development.
Highly consistent. It simply means losses continue to come in below their ultra-conservative expectations. Kinsale's reserve methodology is designed to maintain significant conservatism, which just creates a reliable tailwind to their earnings year after year.
Okay, let's move on to reinsurance strategy. It's often misunderstood, isn't it? It's not just a hedge.
Not at all. It's a sophisticated tool for managing capital, volatility, and optimizing your risk profile. The way these three companies use reinsurance really reveals their distinct strategic priorities.
Let's start with AXIS Capital. They seem to be focused on growing their reliance on third-party capital partnerships.
They are actively leaning into that trend. A major initiative this quarter was the launch of their Access Capacity Solutions division, and it immediately transacted its first deal, the RAC Re sidecar partnership with Ryan Specialty.
So this sidecar, it essentially allows outside capital to participate in their underwriting risks.
Exactly. It's third-party capital participating in highly selective, profitable underwriting risks sourced through Ryan Specialty's MGUs.
And what's the strategic angle for AXIS in launching this?
AXIS gets the benefit of fees and stable, non-volatile premium income, all without deploying its own balance sheet capital. They expect to retain about a third of the gross premiums written generated by RAC Re, while also earning valuable fee income on the ceded premiums.
Sounds like a win-win.
And they structured it carefully. The profitability trigger for Ryan Specialty only kicks in after the underlying business is profitable, so they've incorporated lessons learned from prior market cycles. In addition to this, AXIS is strategically keeping more of its own well-priced core business, which is why their net written premiums were up 11%.
Right.
And for property catastrophe protection, they confirmed their crucial excess of loss, or XOL, protection attaches at $100 million per event, which is their established risk tolerance.
Shifting to James River Group, we know reinsurance was instrumental in their legacy cleanup. What about their forward-looking retention strategy?
Well, the legacy retroactive covers absorbed that $51 million charge, serving their purpose beautifully. Now, looking at the future, their retention strategy reflects management's renewed confidence. In their core E&S segment, net retention exceeded 58% this quarter.
And that's up from last year.
Up from 56% last year. If you believe the new portfolio is profitable, you want to retain more of it. And management is clearly backing their new underwriters with their capital.
But the most decisive retention move was in their specialty admitted division, specifically relating to their commercial auto exposure.
Yes, and this is absolutely crucial for understanding JRVR's de-risking. They have decisively shifted away from retaining volatile commercial auto risk within their specialty admitted fronting business.
How much have they cut it?
Retention in this segment has been dramatically reduced to below 5%. It was 3.7% this quarter. This is a far cry from their previous model. This means James River is largely acting as a fronting partner for commercial auto, using its licenses and ratings, but retaining virtually none of the underwriting risk.
So they're managing that segment purely for the fee income and investment return.
Exactly. It's a deliberate strategy to dramatically shrink their risk profile in a known casualty pain point. That reduction to 3.7% in a line like commercial auto is just a very strong signal that JRVR is entirely dedicated to minimizing volatility.
It is a decisive move.
Yeah.
They are saying, we don't want the risk from this segment, and they're using reinsurance to effect that surgical change.
Precisely.
And finally, Kinsale Capital. We touched on how their reinsurance decisions directly affected their reported expense ratio.
Right. So Kinsale chose to increase its retention levels when they renewed their reinsurance program on June 1st. This resulted in their net earned premium growth of 17.8%, significantly outpacing their GWP growth of 8.4%.
They're just capturing more of the highly profitable risk they write.
Exactly. Their ceded premium ratio was 17% for the quarter. And as we explained earlier, the reason the expense ratio edged up slightly was due to the mechanics of ceding commissions. Less ceded premium means less ceding commission income, which is a trade-off Kinsale is clearly happy to make in exchange for capturing more of their elite underwriting margin.
So we see three very distinct strategies. AXIS using reinsurance to scale through third-party capital.
JRVR using it to wall off the past and surgically de-risk volatile lines.
And Kinsale using it to maximize net retained profitability, even at the cost of a slightly higher reported expense ratio.
It's a fascinating contrast. The Q3 market environment presented a really complex picture, characterized by a softening property market due to capital inflow, but continued discipline in casualty lines, which are still struggling with social
Great.
inflation.
It's a real tale of two markets. Let's see how each company navigated those cross currents. What was AXIS's experience on pricing?
AXIS found significant strength in the liability market. They reported that overall liability rates were up 10%, with U.S. excess casualty seeing an even higher 12% increase. This just confirms that severe casualty lines are still benefiting from significant rate adequacy.
So they're leaning into that.
They are actively leaning in to the highly premium, adequate, wholesale, lower middle market segment, capitalizing on their expertise there. But the property and cyber sectors tell a very different story.
Right, more competition there.
A lot more. In property, AXIS noted that rates varied widely across their diverse portfolio. They observed greater competition in large account E&S business, that's where capacity is flooding in fastest, but they were still seeing respectable rate increases in small account business.
Which again underscores the importance of segmenting the market.
It does. And cyber insurance, a line that has seen extreme volatility, is an area of concern for AXIS. They observed increased competition from MGAs and surplus capacity, exerting what they called unwarranted downward pressure on pricing.
Unwarranted downward pressure, that's strong language.
It is. It's led them to adopt a highly selective approach, effectively reducing exposure where they feel pricing integrity is being compromised.
Okay, and James River Group's rate changes seem to confirm this stark split between softening property and firm casualty.
Absolutely. Their casualty rates were up 11% year-to-date, though they did moderate slightly to 6.1% increases in Q3. They saw notable specific increases in volatile lines like commercial auto, which was up nearly 30%, and energy, up 19%.
But what about property?
Well, the excess property market provided the most chilling statistics. JRVR reported that excess property rates declined to 19.6%.
Wow, nearly 20% down.
Yes, they cited a significant increase in market capacity and pressures, and they expect continued double-digit decreases in that line.
So how does JRVR respond strategically to those collapsing property rates?
Their strategic response is to shift away from the large account pricing wars. They are intentionally moving towards smaller accounts with lower average premiums, which management believes have historically proven to be more profitable and less susceptible to the intense competitive pressure hitting the larger account segments.
Makes sense. And what was Kinsale's overall view of the market competition?
Kinsale described the E&S market as simply competitive. They noted their overall pricing trends were similar to the widely followed Amwins index, which reported a slight 0.4% decrease overall.
We should contextualize that. A 0.4% decrease might seem small, but given the persistent high inflation in claims costs, any decrease in pricing power means a fundamental reduction in profitability margins.
That's a critical point. And for property specifically, rates were still declining in commercial property, estimated to be down in the high single digits. They also sounded the alarm about the flood of new capital entering the E&S space.
Right, the new MGAs and fronting companies.
Exactly. Kinsale explicitly acknowledged a significant increase in competitors, including hundreds of new MGAs and many new fronting companies, all fueled by that inflow of capital seeking the relatively higher returns E&S offers. However, this is where their efficiency edge really comes into play. They remain confident that their technology-driven, low-cost provider advantage allows them to gradually take market share from their higher-expense competitors, regardless of the level of competition. Their ability to, quote, bind and service business at a lower cost basis means they can profitably write business that their competitors simply cannot.
We've established that technology and efficiency are now the central battlegrounds. So let's look at how management teams are planning for the future. Capital allocation, technology spend, key risks, starting with AXIS Capital's outlook.
AXIS management provided very clear, confident guidance. They're targeting mid to high single-digit insurance growth in 2026, with potential for double-digit growth if you include that RAC Re sidecar partnership. So they're planning for a continued, robust, but disciplined expansion.
And their commitment to modernization, which we mentioned earlier, it seems to be accelerating dramatically.
It is accelerating significantly. AXIS initially pledged $100 million into operational infrastructure, but they have really ramped up that spending. They're now projecting approximately $150 million over 3 years for technology, AI, and platform modernization.
A 50% increase in their planned spending.
Yes, including the deployment of their next-generation underwriting platform in North America. They view this spending not as an expense, but as critical fuel for sustaining their profitable growth and achieving that 11% G&A ratio target.
There was a unique technical discussion point in their earnings call, centered on the elevated paid-to-incurred ratio. Can you quickly explain this metric and why it often draws analyst scrutiny?
Sure, so the paid to incurred, or PI ratio, compares the amount of cash paid out in claims during a period to the total amount of ultimate losses expected for those claims. If the ratio is very high, it can sometimes be viewed skeptically, as it might imply an aggressive schedule of paying claims relative to reserving for them, potentially signaling reserve inadequacy down the line.
But management addressed this head-on.
They did, viewing the ratio over a continuum. They argued that their elevated PI ratio is actually a positive reflection of several strategic improvements.
What were those factors?
Firstly, their portfolio mix shift toward short tail lines, which are now over 50% of their business, naturally increases the PI ratio because claims close and pay out faster. Secondly, they cited significant operational improvements in their claims organization. For instance, North America claims closing ratios improved from 98% last year to 118% this year.
Which means they're closing claims more efficiently.
Exactly, including large, fully reserved, pre-2019 claims that were material to their financial insurance book. Management stated they're very comfortable with the trend, viewing it as evidence of improved claims velocity and portfolio mix, not reserve trouble.
Okay. Moving to James River Group, their outlook is all about solidifying their transition and realizing internal savings.
That demarcation narrative between 2022 and prior performance versus 2023 forward remains the absolute priority. Management cited the decisive underwriting actions, implementing sublimits, exclusions, shifting business mix as the foundation for their continued improved performance.
And they announced a major corporate change expected to yield some real financial benefits.
Yes, the planned completion of their redomicile from Bermuda to Delaware expected on November 7th. And this is not just an administrative change. This transition is projected to bring significant financial benefits.
Such as
$10 to $13 million in one-time tax savings during Q4 2025, plus another $3 to $6 million in ongoing quarterly expense savings going forward. So this move is meaningfully accretive to their earnings and validates their strategy of focusing on the U.S. market.
And how are they handling capital allocation, especially given their high adjusted ROE?
JRVR confirmed that they have stepped up opportunistic share repurchases. This is driven by generating excess capital from their mid-teens ROE relative to their high single-digit growth. While their priority for capital remains business growth and continued platform investment, they're now clearly in a phase where they can start returning that excess capital to shareholders.
Finally, what does Kinsale Capital's management outlook signal for their future strategy in this increasingly competitive environment?
Kinsale is doubling down on what got them here: technology and efficiency. They're continuing heavy investment in what they call their target state architecture, which is a complete rewrite of their enterprise system, effectively future-proofing their technological advantage.
And they're using AI.
They're making ample use of new AI tools across the organization to maintain their significant cost advantage over the competition. This technological moat is their primary defense against all this new capital inflow.
They also had a key management succession event this quarter.
They did. Management noted the retirement of their president and COO, Brian Haney, who moves to a senior advisor and board director role. And they congratulated the well-earned promotion of Stuart Winston to chief underwriting officer. This suggests a really smooth internal transition, maintaining continuity in their core underwriting philosophy.
And their growth targets haven't changed.
Despite the competitive environment, Kinsale Management reaffirmed their long-term growth expectation of 10% to 20%, driven almost entirely by their unique advantage as the undisputed low-cost provider in the E&S space.
We have completed a massive deep dive, uncovering 3 distinct but equally compelling stories in the Q3 specialty P&C market.
We really have.
We saw AXIS Capital demonstrate consistent strength and global resilience, fueled by that huge $150 million modernization drive. We analyzed James River Group's complex but successful turnaround, defined by deliberate de-risking and that clear demarcation between legacy failure and current portfolio success.
And we examined Kinsale Capital's elite efficiency, which continues to drive extraordinary profitability and growth, even as competition floods the market.
The consistent thread linking all 3 narratives, though, regardless of where they are in their corporate journey, is the foundational reliance on technology and data.
It absolutely is. Whether it's ACXIS's accelerated $150 million tech spend, Kinsale's complete system rewrite, or JRVR's platform enhancement to support its new underwriting standards, superior technological infrastructure is now the absolute core requirement for success.
This level of operational and technological discipline is clearly what separates the sustainable success stories in a market that is otherwise starting to show cracks in terms of pricing power, especially in the property sector.
That's absolutely correct. And I think the final thought for you to mull over is this. If the speed, cost effectiveness, and efficacy of technology deployment is now the central competitive differentiator, how much runway do traditional high-expense insurers have left against companies like Kinsale, who were essentially born digital and continuously invest to widen that gap?
That's a great question.
The evidence from this quarter suggests that capital expenditure in underwriting technology might soon be viewed with the same strategic importance as investment returns. It is now the primary battleground in specialty insurance, superseding even raw rate competition.
That's a profound note to end on. Thank you for taking this deep dive with us today. We encourage you to explore these concepts and the source materials further. We'll catch you next time.